So, revenue recognition has profound impact on the stock prices, revenue recognition has profound impact on the profits, and 50, not 50, even more than half of the frauds that we see almost will have some element of revenue recognition. So, there was no revenue, but it was recognized. So, what is the previous standard? So, essentially when we talk of revenue recognition, to put, see, this is a basic class on accounting, this is not a chartered accountants class, or this is not a 10th course on finance that you are taking, this is the first course. So, for the purpose of this course, we will say revenue is to be recognized when goods are delivered or services are rendered. When goods are delivered or services are rendered, that is the essence of what was the accounting standard earlier. And the cash is either received or we are almost assured that the cash will be received. So, if I am selling a laptop or a jug, if I am selling a jug, let us say for 100 rupees. So, I say selling a laptop. So, I am selling a jug or selling a laptop. So, when I deliver the jug or deliver the laptop, you can say that yes, in the case of a product, there is delivery of the product and I can recognize the revenue. If I am rendering a service, let us say I am in the business of repairing a laptop. So, when I repair the laptop, the service is rendered and I can say that the revenue can be recognized. And that is the essence of this. So, then of course, we have what are the kinds of business that we are talking about. First one was the product business, where I was delivering a product. Second was the service business, when I was rendering some service. And when we deliver the product or when we render the service, we can recognize the revenue. There are other types of businesses also, which are called as construction contract. These are actually project business. These are project business, and in the project business, how we recognize revenue, we will see how it is to be recognized in the future slides. But coming back to the standard, this was the essence of the previous standard on revenue recognition, and under US GAAP and under IFRS, they had come up with a new standard of revenue recognition, which talks about 5 steps that must be ensured or taken for the purpose of recognizing revenues. Let us go to the next slide. So, these are the 5 steps, and these 5 steps we will discuss in the next class. The reason is, first become clearer with the basics, and in the next class I will briefly talk about the 5 steps for revenue recognition. So, but broadly, what are the steps? First is identify contract with the customer, there has to be a contract. Identify its separate performance obligations. So, there might be a contract which says I will deliver 1 jug and 1 laptop. So, if the moment I deliver the jug, I can recognize the revenue for the jug, and as far as the laptop is concerned, I can, let us say I will deliver the laptop after 1 month. So, I will recognize the sale or revenue when I deliver the laptop after 1 month. So, these are the 2 separate performance obligations. Determine the transaction price. The price of the jug is 100 rupees, price of the laptop is 50,000, total price was 50,100. Allocate transaction price to the separate performance obligations. Allocated is jug 100, laptop 50,000. Recognize revenue when entity satisfies the performance obligation. So, when I delivered the jug, I recognize the revenue for the jug, 100 rupees. 1 month later, when I delivered the laptop, I recognize the obligation for the revenue. I recognize the revenue for the laptop, 50,000. but we will discuss it in greater detail in the next class, but the basics is already understood, right? What is the essence of the revenue recognition standard? Next. So, effect we will again we discuss in next class when we determine the when we discuss the standard. Next. Yeah. So, I said we have three types of businesses. One was the product business where we spoke about delivery of the good. One was the service business where we spoke about rendering of services. And another type of business is a project business. So, this accounting is called as construction contract accounting. It is called as construction contract for a different reason. So, here what is happening is, let us say I am just giving two examples, right. It is not, construction contract is not to be seen as construction per se, right. It is the nature of the contract, it is project business, like it is a big project, and so if a big project, let us say the construction of IIM Sirmaur campus, let us say. So, it did not happen, can you construct such a big campus in one day? The work has been going on for last 8 years, right. The work has been going on for last 8 years. So, this is a long term contract, right. So, the contractor, should he recognize the revenue after the final handover? And we all know that even the final handover is still not done, we know that, right. There are areas which are still to be constructed, right. So, should he recognize the revenue on the final handover, or depending on how much work has been done, he can recognize the revenue on a partial basis every year, because the costs are still being incurred by the contractor on a partial basis every year, right. So, if see costs are being incurred like this, year 1, 2, 3, 4, just say it is a 5-year project. So, costs are broadly being incurred like this, right. If we recognize the revenue, these are the costs. If you recognize the revenue in year 5 only, so in year 5 the revenue will look like this. Do you see that? And in years 1, 2, 3, 4 there is no revenue, right. That would be, will we have matching of costs and revenues? Costs were spread every year and revenue is recognized only in the last year. This is also a method of accounting. This is called as a completed contract method of accounting, which we will see as to in which cases we do that thing, right. In which cases we apply the completed contract. But broadly, revenue should broadly be recognized, not finally in 1 year, but let us say something like that, you got it. So, that there is matching of cost and revenue. So, let us talk about, instead of IIM Sirmaur campus, which is such a huge campus, let us talk about development of 5 bungalows. We have to develop 5 bungalows, A, B, C, D and E on this plot of land. This, let us say every bungalow will take 1 year, let us say. So, in year 1 we make A, in year 2 B, in year 2 C, and the project cost is, let us say 50 crores, say 10, 10, 10, 10, 10, right. So, not the project, or the revenue for the project is 50 crores, cost is say 40, 45 crores, whatever. Shall we recognize the revenue only in year 5 after completing all 5 bungalows, or if we are completing 1 bungalow per year, then we can recognize, okay, year 1 mein we built 1 bungalow, out of 50 crores, let us recognize 10 crores. Year 2 we built second bungalow, let us recognize another 10 crores. Third bungalow, another 10 crores. Are you getting it? Year 1, 2, 3, 4, 5. So, mentally are you able to see what is percentage of completion method of accounting? So, this is what it is saying, that percentage of completion method recognizes revenue on long term contracts as production occurs. It does not require waiting until the final product is delivered. You know, we will recognize revenue on when all 5 bungalows are built. Then to it is exactly this situation, right, that last year this becomes the completed contract method, that we will recognize revenue only in the last year while we are incurring costs every year. So, there is a mismatch of revenues and costs, and in this case we will recognize revenues again 1/5 at a time, assuming it was a 5-year project. So, what happens in real life is, in construction contracts, in project or in project business, they come up with milestones. Usually they will say, okay, fine, we will pay 10% advance, because to help you to procure goods, services, you have to set up a big team at any project site, so that requires cost, right? And then on completion of first milestone, it will have at least 5-6 milestones. On completion of first milestone, we will pay you 20%. On completion of second milestone, we will pay you another 20%. Third milestone 10%, fourth milestone 10%, fifth milestone let us say another 20 or 25%. And then they will still keep at least 5 to 10% for the end. That okay, even after all the milestones are done, we, for any major project, they say okay, we will need to test everything, right? So, I will test everything and then give. For any machinery or anything at any project site, you will see they will have commissioning. Somebody has to go and commission the machinery. So, you have to do commissioning at the site, and once the commissioning happens, then you get another 5%. So, and then final testing or provisional testing, we will give another 2 or 5%. So, some part is withheld, but a majority of it is released, so that if there are any errors in construction, if there are any errors in project, then they are remedied before the final payment is released. This is how mostly a project contract looks like, right? So, percentage of completion method does not require waiting until the final product is delivered. Associated expenses must be recognized by the company, which we have seen here in this diagram, and appropriate only if there is surety of receiving a payment, progress measures are dependable. You should be able to measure the outcome and the progress, right? If you are not able to measure, then again we have some problems. So, for example, at least A is done, give 20%, B is done, give another 20%, C is done, give another 20% in this case, right? And contract obligations must be clear and progress must be measurable. So, this was the case of, let us say, some kind of a long term project. Now, I have worked, whatever I was telling was plain from experience only, but there is another project that I am reminded of, which I had worked long back, and that project basically was about a company. It was a telecom software company which was providing IT related services to telecom companies, right? And in that particular case, they will have services that were measured in terms of man hours, services. So, if we are suppliers of services to other companies, so these services we have to provide, let us say long list of services. The services were measured in terms of man hour. So, the total expected budgeted man hour for the project, I am now giving a separate example, right? This is the budgeted man hour, and I have no clue whether it is in your syllabus or not in your syllabus, I have no clue, but this is part of revenue recognition. So, technically it is in syllabus, and if I have said something in class, it automatically becomes your syllabus, right. So, budgeted man hours is 2000 hours, right, 2000 hours. In this month, I have to recognize revenue. What is the budgeted man hours? 2000 hours, right. In this month, we performed, multiple people were working on the project site at the client location, and the actual man hours spent this month is 500 hours. Budgeted man hours is 2000, this month we have spent 500 hours on the project. So, what is the percentage of completion? 25%. So, POC or percentage of completion is 500 by 2000 equal to 25%. Next month, I have spent 300 man hours on the project. So, next month's POC is how much? 800, 500 plus 300. In this month, I only spent 300, but the total POC is how much? 500 of previous month plus 300 of this month. So, 500 plus 300, 800 by 2000. So, it is 40%. Assume that this month, because of some unforeseen reasons or because of some wrong estimate given earlier, the budgeted man hour, which was supposed to be 2000 hours, goes up to 2400 hours. Now, suddenly we realize that the budgeted man hours is not 2000 hours, the budgeted man hour is 2400 hours. So, in such a case, what will happen is, this was the case if there was no change, but if there is change, then POC is how much? POC in case of change in estimate, I am just writing change is 800 is okay, but budgeted is not 2000, it is 2400 now. So, we have POC as 33.3%, right. This case, which you will see very often in life in case of projects, is called as a time overrun, because the estimated time to complete the project was 2000 hours, but now it will take us several more months to complete the project, because the estimated time has shifted from 2000 hours to 2400 hours. As a result of extra hours, our cost, we still have to pay cost to our employees, salaries to our employees, right. So, let us say we have to hire one more person to do the job. So, in that case, in addition to the extra time, we will incur extra cost to complete the project, and that extra cost is called as a cost overrun, because there was extra cost, then it is called as cost overrun, and when you have to incur extra time, it is called as time overrun, and both cost overruns and time overruns are very usual. You will see them very often in case of long term projects, because some unforeseen situation arises, as a result of which you have to incur extra cost or extra time to complete the project. So, in addition to the examples that we saw, we can have service business also, long term service contracts, long term supply contracts, which can be measured in purchase or percentage of completion method. Next. The other method, there are multiple methods, but POC method, there are other ways of measuring the percentage of completion, but the idea is not to go into every single method of calculating the percentage of completion. This is broadly the concept, right. Another method is completed contract method, and basically this method is, here we were recognizing revenue proportionately. In completed, so little bit every year, right. In completed contract method, we will recognize revenue at the end of the contract, which is this case where I drew that red line, that all the revenue is recognized at the end. It may not be fair because the costs are incurred over the years, while the revenue is recognized only at the end. And so, this method is basically saying that revenue is to be, the recognition of revenue is to be delayed until of both. In that case, of course, we will say not just the revenue, but the cost also has to be delayed. Recognition of revenue and cost both have to be delayed, both until the completion of the contract. So, for companies, and what are the situations in which we will utilize this method? For example, under US GAAP, they talk about when there is uncertainty about customers paying at the end of the contract. So, you never know whether you will get the money or not. So, why recognize revenue if you do not know whether you will recover something at the end, or where the outcome of a contract cannot be estimated reliably. You might have heard the news recently that Pakistan has discovered amazing oil and gas reserves, right? And suddenly Pakistan has become rich, assuming that the estimates are correct, So, when they will be exploiting those oil and gas reserves, then they will become rich, right? So, when you start drilling, are you always sure that you will find oil and gas? So, do you see what I am saying? So, there is always an uncertainty about the outcome of a project, and in oil and gas projects, uncertainty about finding the right location is always there, right? As in, there is always uncertainty that whether when you are drilling, you will find something or not. So, for companies reporting under IFRS or US GAAP, when there is uncertainty about the outcome of a contract, or when there is uncertainty about getting the payment, then in such cases you feel that okay, fine, let us recognize the revenues and the costs at the end of the contract rather than during the contract, because if there is no certainty कि कुछ पैसे आ रहे हैं, why unnecessarily recognize it, right? The conservative principle says recognize revenues, recognize incomes and gains when you are reasonably sure that यहाँ होने वाले हैं. Otherwise, when it comes to expenses and losses, we say recognize, but in this case, since you are deferring, we will also be applying the matching principle, which says that you delay the recognition of both revenue and related expenses. Because otherwise, so your profit and loss account will go for a toss, right? Your profit and loss account will go for a toss, that every year you are incurring expenses which you are recognizing while you are not recognizing your revenue. So, the matching principle also has to be kept in mind, even though the conservative principle is to be followed. Next. So, having understood the key methods of revenue recognition for goods, services and long term projects which are called as construction contracts, let us now look at accounting for sales and allowances for sales returns and allowances, sales discounts, credit card sales and allowances for uncollectible accounts. So, what you see here in my slides as allowances for uncollectible accounts, that is a US terminology. In India, we very often call it as provision for bad debts, right? It is the same thing, provision for bad debts. Next. So, this is simple. When we make a cash sale, what is the accounting entry? Cash debit, sales credit. When we make a credit sale, what is the entry? Accounts receivable debit, sales credit, right? Debtors to sales or AR to sales, right? Next. Measurement of sales revenue becomes, when it is measured in cash, there is no issue, 100 rupees cash. But do you remember day 1 when I was talking about barter system? So, I give to Sandeep, So, I give to Sandeep 1 bag of rice and he gives me back not 100 rupees cash, he gives me back 1 bag of wheat. Then it becomes difficult to measure what is the monetary value, right? Maybe I gave him rice worth 99 rupees and he gave me wheat worth 98 rupees. We do not know. So, but it becomes difficult to measure it. So, sales revenue measurement is complex when the cash equivalent value of the asset received is not obvious. So, one is a barter system, receiving goods or services instead of cash. Second is cash received is less than the listed price of item, or inability or unwillingness of customer to pay amount owed. So, when I know, let us say he is bankrupt or about to become bankrupt, then does it make sense to first sell him? It is not a great business decision, right? And then to recognize the revenue when we are possibly thinking whether he will be able to pay or not. Are you getting it? So, in such cases, it is better, or it is a complex task to recognize revenue, right? Probably better not to recognize than to recognize in the example that I gave. Next. So, what are gross sales? Total amount of sales before deducting returns, allowances and sales discount, right? Net sales, total amount of sales after deducting returns, allowances and sales discounts. And amount actually received that constitutes revenue to the company clearly, right. So, gross less all these returns, allowances and discounts gives you net sales. Next. So, what are the deductions? One is a sales return or purchase, when you do purchase and purchase return, right. So, sales return or purchase return has to be deducted from, not purchase return, but sales return has to be deducted from sales. Sales allowance or purchase allowance, sales return and sales allowances are to be deducted from gross sales to determine the net sales. This is absolutely clear. So, I am moving forward. Next. So, the question was, what is a contra account? Now you know what is a contra account. So, contra account reduces the, in this case, contra means reverse. Contra means reverse, right? Opposite, reverse or opposite of what is there. So, contra account reduces the, so sales account and the contra would be sales return, for example, reduces the revenue account, combines both returns and allowances, helps monitor changes in the level of returns and allowances, and helps in forecasting demand and managing inventory. Yeah, this is because, why is the last, look at the last point. At times, when I sell a jug, let us say this jug costs 1 rupees and I sell this jug to all 60 of you. My past experience tells me that on an average, every year, on an average, 1% does not pay. So, I sold this jug at 1 rupee each. So, I should have collected 60 rupees if I sold it to 60 people, but past experience tells me out of 60, 1% does not pay. So, I will only get how much? 59. So, this is what it is saying, helps in forecasting demand and managing inventory, because if I know, then immediately I should create some kind of a provision कि यार एक आदमी का पैसा नहीं आएगा. It may be that deep will not pay, let us say. Next. So, what is merchandise returns and allowances? A company has 9 lakh gross sales on credit and 80,000 sales returns and allowances. So, what is the journal entry? The journal entry is very simple. For the first one, what is the entry? Sales 9 lakh. So, debtors to sales or accounts receivable to sales 9 lakh. For the second one, sales returns and allowances 80,000 debit, right? Accounts receivable credit, because what is the net sales? Net sales is, if you look at it jointly, then the net sales is 8 lakh 20 and accounts receivable, if you look at it jointly, is 8 lakh 20. You can see it, right? And sales return and allowances then is a contra account of sales, because when you, so this is like the gross sales less sales returns and allowances 80 equal to net sales of 8 lakh 20, right? Everyone clear? Next. So, what are trade discounts? Trade discounts are reductions to the gross selling price for a particular class of customers. So, please remember, there is a difference between trade discount and a cash discount. What's the difference between trade discount and cash discount? So, anyways, the point is trade discount or sales discount does not appear on your bill. So, if you sold something where the list price is say 110, only the list price at 100 rupees. The list price is 110, you sell it for 100. So, you will record a sale not for the MRP or the list price, you will record a sale for 100 rupees, not 110. So, that is the trade discount. You got it now, or sales discount. Having recorded a sale at 100 rupees, you tell the person, I am selling it to you 100, normal trade terms is we give 30 days credit in our industry. So, you have to pay within 30 days. But if you pay me within 5 days, I will give you 1% discount. So, you do not have to pay me 100, you only have to pay me 99, right. So, 110 to 100 was a trade discount or a sales discount, and it appears nowhere in your invoice or bill, because the invoice or the bill was generated for 100 rupees. But this reduction from 100 to 99 is for early payment. If you pay fast within 5 days, I give you 1% discount. So, you can either pay in 30 days, in which case you have to pay 100 rupees, or you can pay in 5 days, in which case you have to pay 99 rupees. So, this 1% discount is on account of paying fast, and it is called as a cash discount. So, cash discount is the reduction in amount owed by customer. So, n by 30 means the full billed price, net price is due on the 30th day after the contract or of the invoice date. N by 30 means pay within 30 days. And what is the second one? 1 by 5 comma n by 30 means pay within 30 days, normal credit term, or if you pay within 5 days, then you get 1% discount. I was just explaining this deliberately in our example, so that you understand both what I was saying and this together. Got it? If you pay within 30 days, you have to pay 100 rupees, but if you pay within 5 days, I give you 1% discount. So, instead of 100, you only pay 99. So, that is what it means, 1 by 5 comma n 30, 1% discount if paid in 5 days. And what is 15 UM? UM means end of the month. So, full price is due within 15 days after the month. So, today is 13th of September, 15 UM, when is the month, when is the payment due? 15th October, right, end of the month. So, this month is not counted, 15 days after the end of the month. So, any sale of September, if the term is 15 15 day after the end of the month. So, after 30th September 15 days. So, we have to pay within 15th of October. So, in this case 15 for a sale of 20th of December, the due date is January 15, that is the due date, right. Clear na? Next. Next. Product sold at 30,000 on terms 2 by 10 and 60. So, normally 60 days, and what is 2 by 10? 2% if paid within 10 days, right. So, we sold for how much? 30,000. So, what is the accounting entry for sale of equipment of 30,000? AR2 sales, right. AR2 sales how much? 30,000. And then cash is collected, this is called as the gross method, cash is collected at discount. So, cash account debited. How much did we get after 10 days? Did we get the entire 30,000 or did we got only 98%? We only got 98%. So, cash debited 98%, which is 29,400. Cash discount debited. Why is it debit? Because it represents an expense in some ways, right. It represents a reduction in stockholders equity from our transaction analysis table. So, cash discount on sales 600, account receivable is credited. Why is credited for 30,000 when we only received 29,400? because we are not receiving the balance 600, right? Even though the amount owed was 30,000, we will not receive the balance 600. So, this balance 600 represents in some way a cash discount for early collection, or in other way if you look at it, it is a reduction in stockholders equity, or you can see it in some other way, you can see it as an expense, right. So, that is the reason cash discount on sales is to be debited. And what if the full cash, if was so if 30,000 ka sale hua hai, if the payment was made in 10 days, we give this 2% discount. If the payment is made in 60 days, there is no discount, you pay the entire 30,000. And why do we give this discount? Because if we have this extra 60, almost 30,000 rupees, almost 30,000 rupees extra with us, with that 30,000 rupees we can do more business, right. So, what is the incentive for us? Using this 30,000 rupees, I can do more business, I can buy more and sell more, right. So, this is the advantage of extra money, because if we have more working capital, then we can do more business with our money, right. So, this was the gross method. There is another method called as the net method, which is coming up in the next slide, but next slide mein jao. But we can ignore this method, I would say, because here it is treating, if you see, as a sale of only 29,400, and then it is treating the extra 600 as a interest revenue. So, we will just ignore this method, we will focus on the gross method, which is much easier, right, because that extra 600 is not actually an interest revenue. So, we go with the first method, which is the gross method. Next. Advantages of cash discount, lot of advantages. How many of you have worked, how many of you have work ex? Chalo हाथ उठाओ अपना अपना 1 2 3 4 5 12. अच्छा double work ex है. Okay. Okay, wow. She raised hand and she was like victory sign कि भैया 2 साल किया है. How many years have you worked? 15 months. Okay. Okay. But and how many of you have worked in sales? How many of you have worked in sales? Nobody.
Not exactly, but marketing.
Marketing. But have you seen, at least if you have work ex, have you seen the bosses telling the people, especially in the sales people, जाओ जाके payment लेके आओ? Have you seen that?
Yes.
Call the person, ask हमारा payment कब करेगा? You have seen that? Why? Because if you don't get cash, what's the point of selling? If I sell the jug to him at 100 rupees, and if I don't get the cash, is there any point of selling it to him? And in business, we want to collect our cash faster, because we have to pay for our day-to-day expenses of business. If we don't collect fast enough, then anyways our creditors will come, हमारे पैसे दो, they will run after us, give us our money. So, we ourselves need to be very prompt in collecting, right, to meet the day-to-day expenses in the first place, and second, to ensure that if we have more cash, then we can do more business, we can buy faster and sell faster if we have more cash. And so, the other part is, let us say Sandeep genuinely wants to pay me, he genuinely wants to pay me, but he is, right now he has money, unfortunately 1 month later, unfortunately he becomes bankrupt, let us say. 1 month later, touch wood, yeah. 1 month later, can he really pay? We don't know that 1 month later he will become bankrupt, yeah, right. Business situations may change. This is just an example. We all wish the very best to Sandeep, but this is just an example. If I have collected the money when he was still solvent, my interest is protected. Even though instead of 100 I got 98, I am still happy. 98 to I, right? With that 98 I can do more business. But because of future uncertainties, if he becomes bankrupt, then I am anyways gone. I am also losing a big chunk of my money. So, that is the point. So, if you are connecting promptly, it is also reducing the risk of future bad debts, because bad debts can happen only if the money is outstanding. If you have collected, then there is no bad debt, and it is a way to compete with other sellers also, right. Next, yeah, credit card transactions. So, credit card transactions, so I won't you already, all of you know how the credit card business works, right. So, he is a retailer, he sells to me, I pay to him using credit card. He sold to me for 100 rupees. If I had given him 100 rupees cash, he would have shown it as a sale of 100. Even now he will show it as a sale of 100. But he will say, in the first case when I was giving him cash, he will say cash received, cash account debited to sales account 100, 100. But when I use credit card, the sale is of 100 only. The same Colgate toothpaste has been sold to me for 100 rupees. But he did not, I paid him by credit card this time. So, the credit card, because of a credit card, he will not get 100 rupees. He will, after a deduction of let us say 3 rupees, he will get 97 rupees. So, this 3 rupees is effectively an expense for him, right. This 3 rupees, but the sale is of 100 only. So, he will say sale is credited by 100 only, but cash received is not 100 or bank amount is not 100, it is 97, and the balance 3 is a credit card expense. You got it, na? Or credit card charge. So, this is what happens in case of a next. So, cash sales is of 10,000, cash received is or bank account 9,700, and cash discount for bank card. So, it is a bank cash discount for bank card or credit. You can call it cash discount for bank card or credit card charge, or you can call it by whatever name, but this 300 you are not getting it. But if entire 10,000 was paid in cash, what would be the entry? Cash 10,000, sales 10,000, cash debited, sales credited. But if we are, because when we are using credit card, we are only getting not 100%, but 97%, 3% credit card charge has been deducted, and that goes as cash discount for credit card or bank charges. Yeah. Next, and this is simple. Gross, how do you show it? How do you show the gross sales and the net sales? Gross sales 1000 less sales returns and allowances. This is a contra account, right. Cash discount on sales is not a contra account. This is a contra account. Sales less sales returns and allowances. This part is contra. You show it as a deduction, cash discount on sales, and the net sales is 710. Next. Next. So, credit sales. Why do we make credit sales? To increase our sales. To increase our sales.
So, in order to stay in the market, the competitors do provide credit sales. So
Yeah.
to maintain a credit sales. Or
Yes.
you would be like
Exactly.
behind them.
Because if he can, I only say you can buy for me only in cash. He does not have cash. He came to me, I am selling and Aman is selling. Sandeep came to me, please sell this jug to me at 100 rupees, I will pay after 30 days. I say no, I am not selling. Aman is my competitor. He knows I have not sold to him. He goes to Aman. Sell this jug, he also sells jugs. Sell this jug to me at 100 rupees, I will pay after 30 days. Aman agrees on credit sale. He sees that, okay, fine. He will look at his interest. He will say, okay, fine. If I can get 30-day credit for the same price, I will go to him. What is Aman doing? In order to boost his sales, he is effectively selling at a lower price, effectively, because he is losing the interest on 30 days for that 100 rupees. But he is okay. So, effectively he is not selling at 100, he is effectively selling at 99 or 98, right. But I can sleep peacefully. I know I had lesser sales, but I can sleep peacefully till he receives the money. Let us say we are talking of not 100 rupees, we are talking of 100 crore, let us say. Now expand the number. Same thing, 100 crore. For next 30 days, till he gets his payment, he will make 5 calls to him. You remember, you have to pay to me after 30 days? 100 crores, right? 15th day, he will send one of his representatives that please remember that, we need our 100 crores on the 30th day. We can't even wait for a single day. You will anyway start following up. The amount is so big, you will start following up. I don't have to follow up. I tell him, if you want the jug, pay cash, take it. Otherwise, I am not selling it on credit. So I don't have to worry. So the benefit is, for him, the benefit is it increased his sales and profit, but the cost is administration and bad debts. First is administration, send 5 reminders, please pay. What if he paid up to 99 crores? Then he becomes bankrupt, I don't have money. The bad debts. So cost is, one is administration, chase, have people who will chase, you have send a reminder, send a typed letter saying if you don't pay, then he has not paid in 30 days. At 31st day you will send a reminder and almost like a legal notice, this is due, please pay urgently with interest, otherwise I will be forced to take legal action. This is also administration cost. So it requires administration, and bad debts requires critical time and effort, and it delay in receiving payments, right. Next, uncollectible accounts, receivables that credit customers are unable or willing to pay. So these are also called as bad debt expense, or loss arising from uncollectible accounts are called bad debts, right. So the terminology that you will see is allowance for uncollectible accounts in this, it's more like a US terminology. In India we just call it as provision for bad debts, right. Both are right, there is nothing right or wrong, right. Next. So in the specific write-off method, we will specifically write off when so there are two methods that we are talking about for bad debts. For bad debts, we are basically talking of two methods. One is a specific write-off method, one is a allowance method, which is more like a general method. What is a specific write-off method? In specific write-off method, I assume that all sales are collectible until proven otherwise. All sales are collectible until proven otherwise. So if I have sold 60 jugs to 60 of you for 1 rupee, all 60 rupees will be received. That is the assumption. So I am saying everything is collectible until proven otherwise. So Sandeep did not pay. When it is certain that Sandeep will not pay, at that point I will recognize a bad debt expense. So it is called a specific write-off method, because this person did not pay, this customer did not pay. Are you getting it? Specifically this man, he did not pay, right. It is a specific write down method, right. So next. So how do you do accounting? Sales, I sold 60, so I could have written, in this case the example is saying 1 lakh, but in our case that I gave, it is 60. So when I sell, accounts receivable increases by 60, sales goes up by 60, in this case it is 1 lakh. And then write off happens when a particular person does not pay. So what is the entry? Bad debt expense is increased, so bad debt expense debited, which is a reduction in stockholders equity, and decrease the account receivable, clear, right, clear, everyone is clear, right, very simple. Next, bad debt recovery is, since we have just passed the entry for bad debt, when you recover the amount, you reverse the bad debt entry. What was the entry that you passed? Bad debt expense debited, accounts receivable credited in the previous slide, right. So you reverse that entry. So bad debt recovery is, first he did not pay, but suddenly he got his money, let us say one of his uncles decided to pay him a lot of money, let us say. So he got that money, now he has lot of money, he can pay everyone, so he pays me also, right. So because of whatever reasons, he has cash flow and he can pay. So bad debt recovery, we will reverse the write off, and it will handle collection as a normal receipt on account, because whatever we write off we did in the previous slide, we will reverse it. So, once it is reversed, the money is still due. I had reversed him. So, earlier I said bad debt expense debited, account receivable against his name credited, but now I will say no, reverse that entry, right, because he will pay. And then once he pays, it is a normal receipt, cash account is debited, AR is account receivable is credited. Next. So, recovery in 2003 of 500 that was written in 2002, reverse the write off first. This is what was the write off? Bad debt expense debited, account receivable credited, that was the write off. But in next year, when the amount we know is getting recovered, we reverse the write off and then we record the collection as a normal transaction, cash account debited and accounts receivable credited, right. Next. Allowance. So, that was a specific write down method. What was the specific write down method? This person or this debtor did not pay, that was a specific write down method, specific this person. What is a allowance method? Allowance method is a general method based on past experience. Allowance method is a general method based on past experience. My past experience tells me that when I sell 60 jugs to this entire class of 60 students, my past experience tells me that on an average 1% does not pay every year, on an average. It is quite possible all 60 may pay, it is quite possible not 60, not even 59, even 58 only may pay, but on an average 1% does not pay. So, 1 out of 60 will not pay for my jug. So, this is allowance method is the when you are selling 60 jugs, you say okay fine, I recorded a sale of 60, 1 rupee each, but I also create an allowance for 1 rupee because I know 1% does not pay on an average, right. You get the difference. So, in the first case, what was the specific write down method? Only when he does not pay, I say because of him, this is a specific write down method. Here I am not waiting, I do not know who will pay and who will not pay, but based on past experience, when I sell 60 jugs, 1% does not pay. So, it is a general method, I am not even going for a specific person, anyone out of 60 may not pay, quite possible everyone pays, quite possible 2 out of 60 may not pay, but past experience tells 1. So, based on that I chose an allowance to be made for 1 rupee, and that is what the allowance method is estimates the amount of sales or receivables that will ultimately not be collected, and it also is a contra account that contains the estimated uncollectible amount to be deducted from the total accounts receivable. Next. So, allowance method for uncollectible accounts is a contra account that measures the amount of receivables, also called as allowance for doubtful accounts or allowance for bad debts. This is simple. Next. Yeah, so how will you do it? Under allowance method, estimated allowance of, let us say for 1 lakh we had a 2% estimated allowance, right. So, we say okay fine, sales may be made 1 lakh, sales increase, accounts receivable to sales, that is the first entry. In the second entry, without waiting for it to happen that Sandeep will not pay, that was a specific write down method. In the allowance method, I know on an average 2% of people will not pay. So, we say allowance for uncollectible accounts, we provide a bad debt expense and have this allowance for uncollectible. So, it is bad debt expense debited and provision for bad debts, which is also called as allowance for uncollectible 2000. And then when he actually does not pay, let us say he was supposed to pay 1900, when he actually does not pay, then we do not do anything else, we adjust against this allowance for uncollectible, that okay, this allowance which was 2000, we adjust against it 1900, because we anyways created an allowance not knowing who will not pay, but a generic allowance was still created, and against that allowance we will put this 1900 when he actually does not pay. He did not pay, but we will put his 1900 against that general allowance that we created. Next. and following are the generalities. The first AR to sales, second bad debt expense to allowance or provision for bad debts, and then when he didn't pay, then provision for bad debts or allowance. And look at this, here we are specifically saying that AR, which account, which AR? All ARs? No. AR of Jones, AR of Montero, AR of Sandeep. So these are the people who did not pay. So we are crediting their accounts receivable account, right? Not the generic accounts receivable. This was like the entire everyone put together, right? Here we are saying provision is utilized because Sandeep didn't pay, or Jones didn't pay, or Montero didn't pay. Are you getting it? So this is what we are doing next. So allowance method is good because we are utilizing our historical experiences, and it is talking about economic circumstances and uses year end account receivable asset. So next, see, allowance method is represented in balance sheet as account receivable less allowances is net. So gross less provision is net, and this is a contra account. Can you see that? This is a contra account. Account receivable 40 less allowance 2, net account receivable 38. Got it? This is how it will be shown. Next. So there are two ways of estimating the allowances. Hold on, hello. We will reach in I will complete in 3 minutes. There are two ways of estimating the allowance. First method is estimating the allowance against sales. So allowance will be estimated based as a percentage of sales. You made a sales of 100, you create an allowance of 2%. That is the first method. Accounting entry is same. Now the question is, how do you estimate the allowances? Entries we have just seen. Question is, how do you estimate the allowance? You can estimate the allowance using two methods. One is as a percentage of sales. So sales was 100. Actually it should be as a percent of, when you say sales, you always mean credit sales, because for cash sales anyways you are getting the money. So when you say percentage of sales, it should be read as percentage of credit sales. So there is, historically we know that out of credit sales 2% of people don't pay, right. So that is based on a percentage of credit sales, and this is clearly, since it is based on sales figure which is sitting in profit and loss account or income statement, this approach is called as income statement approach, because it is related calculating allowance based on a figure which is sitting in profit and loss account or income statement. So it is known as income statement approach, because we are computing it based on that. The other method next is as a function of account receivable method. So we are and this will be one of the last slides that I am showing, but this is important. So please pay careful attention, and this is what we did in practice also. We will close within minutes, right. So one is as a gross, but this is, even this is what we do not do in practice. If our total account receivable is, let us say 50,000. So on an account receivable of 50,000, our experience tells us that we should have an allowance for bad debt of 3%. So on 50,000 we create. So this is based not on a sales figure, but on debtors figure or accounts receivable figure. Are you getting it? Last time we had it based on, allowance was estimated based on sales. So it was called as percentage of sales, and sales is sitting in income statement. Here the estimated allowance is based on account receivable figure. So let us say the account receivable figure is 50,000, and you past experience tells you 3% of account receivable is not received. Then you say 50,000, 3%, so 1500 is not received. So we create an allowance for 1500. Are you getting it? So this is how to estimate the allowance, but a much better way of estimating the allowance is this. This last, what we will do is we will calculate the age of receivables. We will calculate the age of receivables. So 0 to 30 days, 30 to 60 days, 60 to 90 days, 90 to 180 days, 180 to 360 days, 1 year, over 1 year, over 3 years, and over 5 years. The previous was a gross method, as in like 3% of total accounts receivable will not be received. But is it always the case? This person has not paid us for 5 years. Will he pay? Experience tells us against this person I should have 100% provision. Against 3 years also I should have 100% provision, because if someone has not paid in 3 years, chances are he may not pay. If a person has not paid for 1 year, maybe there was some genuine business dispute, maybe there was some other reason. Against these people, I probably don't need 100% provision, I only need 50% provision. For people who are overdue by 180 to 360 days, this is called age analysis or aging analysis of receivables. I don't need that much provision, I only need maybe 5% provision, because chances are they will pay. Against 90 to 180 days, I don't need that much provision, I only need 2% provision. Are you getting what I am saying? I am just giving an estimated number, whatever, right? And against these people, I don't even need 60 to 90 days, I only need maybe 1%. And against this, only 0.5%. And against 0 to 30, I don't need any provision, right? Are you getting it? Maybe if I at all 0.001%. I mean, are you getting what I am saying? So, this is based on age. This is how we also follow up. The person has not paid for 5 years, ab kya dega? Are you getting it? At least provision to create kar lo. But for this person you don't have to. Are you getting it?
Yes, sir.
So that's the essence. Yeah. एक बार next slide दिखा दो. We are ending it within 1 minute. So this is the balance sheet approach. Next. ये भी हो गया? हाँ. So and this is the aging method which I have just explained. You got it? Yeah. Okay, fine. Thanks a lot. Yeah. Hi, this is Dr. P. Sanjay, and I am a professor at Indian Institute of Management, IIM in Sirmaur. If you like my videos, please feel free to subscribe to my YouTube channel. Thank you.